Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, Deepak takes a look at some unexpected quirks and consequences of investing in mutual funds, or perhaps pooled vehicles more in general, and how your returns and your experience can be impacted by other people's actions, putting money into pulling it out of the mutual fund, even though you've done nothing. So listen in to learn what happens when the mutual fund can't buy more of a security or can't sell one. There's an issue with the cutoff timings and NAVs, and if a large inflow comes in or a large outflow request comes in, that can only be actioned the next day. Situations like DHFL, Yes Bank, and Z, where the fund has an underlying asset that isn't all that great, and how all these edge cases come together around pool vehicles to impact your decisions, whether you're a buy and hold investor or a short-term trader. So do listen in to what Deepak has to say. Hi Deepak. As you know, I've been a fan of mutual funds and I guess more generally pool vehicles for several reasons for quite a while now. It initially started with customers who were, say, lawyers or working at a financial services firm or at a investment firm who couldn't own stocks in their name directly. Then I found it moved on to people who perhaps really wanted to trust us but didn't want exposure to an active stock strategy that may or may not do well. And then finally it became even uber wealthy clients who had many PMSs and AIFs, but who found that in aggregate the return was not that much better than, say, some sort of benchmark, and felt that they could just consolidate all of them into a mutual fund basket as well. Even in times like these, a mutual fund portfolio seems to do fairly well, and we've done some pretty innovative work with like creating a basket of mutual funds that you can access through your PMS with, of course, 50 lakhs into it. And I think those customers perhaps have the least heartburn right now despite the market conditions. So I've been a big fan of these pool vehicles, mutual funds and the like. But when I was bringing this up to you, you pointed out that, and we've seen this a couple of times over the past year, that any pooled vehicle, I mean, it's not the cure-all for all of life's problems or all of investment problems. And there are a bunch of complexities that come with it, or edge cases, where these vehicles may not behave in the way you think they should behave, or may not give you the freedom or the flexibility to achieve what you want to achieve through the instrument for no fault of your own. And I thought this was quite fascinating, so I thought we'd bring you in for this and start with this question. So what are these complexities that you speak of, and why are these tax-free mutual funds or pool vehicles not the solution to all of life's problems?
I think, quite interestingly, Shray, the issue is we like this as pool vehicle as a concept because it's much easier to be able to access somebody else's portfolio, directly participate in them and so on, versus a PMS where every account is individual. So I buy 10 stocks for you and 14 stocks for somebody else. They have separate accounts. The 10 stock portfolio can go up, say 5%. That 14 stock portfolio may go up 8%. The 5% person gets 5. The 8% person gets 8. They might have different proportions of the same stock, so the gains are different. But the gains are very clearly demarcated, right? So when you say, instead of having these multiple individual accounts, take the money, put it into a single pool, and now give each investor a proportionate change of the returns. So it's not like one investor got the gains of 10 stocks, the other one got the gains of 14 stocks. Both get the gains of the same stocks that are in the portfolio, which is a common portfolio in a pool. You might say the mathematical funda is if I put in X amount of money into a pool, you put in Y, the pool is X plus Y. So if the return is, say, 10%, you're getting 10% into, X divided by X plus Y. So effectively the proportion of your fund investment, and my proportion of the gain is my fund investment. And when I say that 10%, it may be in rupees, so it may be 1,000 rupees gain is divided into maybe 600 for you, 400 for me, because I put in 400 and you put in 600. You put in 60% and I put in 40% of the money. I mean, this is less complicated in a different scenario where you're doing a PMS, right? Or a single one-on-one. Because in the one-on-one, you're simply saying, okay, if his account earned 600, it's got 600 rupees. If my account earned 400, it's got 400. But I can't do this at scale. I can't do it as I can do Shray and Deepak. But if I have 50,000 investors, the 50,000 separate trading accounts, then each account has to be traded separately, or each account has to be managed separately, and so on. So at some point, there's a limit on what you can do with aggregate accounts. So we built a lot of software in the PMS to do this. But a mutual fund or an AIF, for instance, is a pooled vehicle by definition. This adds layers of complexity because it's no longer in a mutual fund, for instance. It's no longer like you're putting in money, I'm putting in money, and then you share the returns. It's you're putting in money, something happens, and then you maybe put in more money. Then maybe I withdraw some money, and then I add some more money. I do an SIP. So what is X and what is Y anymore? It's like it's no longer what we started off with. It's something else. So, it's a complex thing. It would be X and X plus 5 and X plus 10, or it would be X minus 15 in another case. So it's like because of this changing environment, you have to create an accounting framework for figuring out what proportion of return goes to which investor. Mutual funds and fund accountants create something called an NAV. They say the pool was created with, say, 100,000 units. And then you have divide that 100,000 units, 100,000 into, say, 1,000 units of 100 rupees NAV each. So you multiply the number of units by the NAV and you get the fund value that's currently there. So tomorrow the fund, nobody does anything, and then the fund value goes up by 10%. So it's worth now 110,000 rupees, 110,000 rupees, but there's still 100 units. So it's 110 rupees per unit, which is the net asset value. If you want to buy more, you buy at the 110 rupees asset value, and no new units are created and given to you. If at the same time, if I sell some units, I sell some units at 110, and the number of units I have reduces the number of units in the pool. So it may be that you buy 50 units. So instead of being 1,000 units, now we have 1,050 units. So the net asset value gets divided accordingly, and the other way around. So because of this pool structure, you've had all these complexities going on. Now this is the overall structure. Now, what happens because of this complexity is you have a single pool that represents the whole underlying shares. And because we love mutual funds, we can look at their portfolio and say, oh, well, you have this, does that, and we say, want to buy because of it. Give an example of a mutual fund that has stocks which are foreign, like Facebook and Google and something like that. So there was 30% of their stocks were with these global stocks. So you might say, okay, you know what? I want access to those global stocks. But the RBI has told this mutual fund that you cannot buy any more foreign stocks. So you put in the money. You put in the money into this fund saying, okay, I'll want exposure to foreign stocks. I want 30% exposure. I love it. 70% can be India. 30% is US. That's great. But more people like you have seen this portfolio. They put in money. What happens is with that money, this mutual fund cannot buy any more foreign stocks. So it will increasingly buy more Indian stocks. So instead of being 30% foreign, they end up being 20% foreign because more money has gone to buy Indian funds, and then 10% and so on. So then you're like, after a while, you're like, excuse me, I bought this because it had 30% foreign exposure. I don't want 10% foreign exposure. It's too little. And then I won't use this fund. I'll choose something else that involves this. So your problem is that if it was a separate account per person, and like in the PMS, if I had bought, you can't buy foreign stocks, but assume I had bought foreign stocks in one person's account. New persons came in and RBI told us you could not buy any more foreign stocks. The new person would not get any foreign stocks, whether the old person would continue to have their 30%, right? So it's different from this privately owned, individual account structure. In a pooled structure, everybody gets everything, which means new capital flowing into your fund. You didn't do anything. You invested. You said the fund had 30% foreign stocks. But unbeknownst to you, and despite the requirement of the manager to want as much foreign exposure as possible, you have been denied this foreign exposure simply because other people invested in the fund. So essentially, the foreign stocks keep going up. You don't benefit as much versus something else. And I think it's the same thing that complexity happens. For instance, if you invest in a small cap fund, thinking that small caps will probably do well in the long term, I want 10% of my allocation to small caps. I take 10% of my fund and money and put it into a small cap fund manager. The small cap fund manager is supposed to invest in small caps, except they were 3,000 crores when you started. They doubled to 6,000 crores. And when they doubled, everybody saw this and then piled on. And now that fund has 30,000 crores. When it has 30,000 crores, it can't find enough small caps to invest. So what it does is it puts 35% of money, the maximum possible, into the large caps. So you now have a fund which started off as a small cap fund, almost 100%, to a fund that has only 65% small caps and 35% are large caps. This is not what you wanted, because you said, I want small cap exposure. That's why I'm buying this fund. Why are you guys buying buying large caps in that fund and ruining my experience in that context? You might say a bunch of things around liquidity, this, that, because, when a pooled vehicle, and I'll come to that as well, when somebody has to sell, you have to have assets that are saleable. So people buy those large caps just for that as a buffer experience as well. But I think given where you are right now, your problem is you started off investing in a fund that had great returns because it was primarily small cap. And you said, I want it to be 10% of my portfolio, so I've given you the allocations. Now you have a fund which is only 2/3 small cap and the rest of it is large cap. And that has ruined your calculations, because you're like, okay, wait, hang on. It was supposed to be 10%. Is it only 6.5%? Should I then be buying more of the small cap fund? Should I be? And you've gone to a pooled vehicle for your diversification in terms of whatever you thought it was by looking at the fund today. But new inflows from other investors have changed it despite you not looking. So today you have no idea. You might go back and say, wait, I have a bunch of mid-cap funds and small-cap funds. So how much actual small-cap, mid-cap exposure do I have? You might see it's actually considerably lesser than what it sounds. Simply because this structure has, the fresh inflows has basically, without your control and perhaps without even the manager's control, changed the mix of what you were investing in.
I completely get that. I was thinking about it, as you said, in the first case, with that foreign stock ban, you are the person who called this correctly. You got in when the fund had 30% foreign exposure, but then you don't have more money to invest. But everyone else, because has started chasing this, so their inflows have diluted your exposure to the foreign stocks, even though you're the one who called it first. So literally someone with more money, or in this case many people with small amounts of money, have managed to hurt you in that sense when it comes to the foreign stocks. And when it comes to the small caps, I guess it's more pronounced. And maybe at this precise moment you feel okay, because I guess the large caps, which are now 1/3 of the portfolio, are falling less than, say, the small caps, which are 2/3 of the portfolio. But the fact is, you wanted small cap exposure and you just can't get it. And again, it's for no fault of yours. But both of these examples you've cited come from inflows. So is that the only time when problems happen? Or are outflows equally problematic in that sense?
In fact, in the outflows have a different layer of problems. Like I told you, one of the reasons these small caps have these large cap exposure is to ensure, that they can sell things. And let me give you this example in a completely different way. Let us say you bought a debt fund. The debt fund had maybe, 70% AAA debt and 30% not so great debt. I mean, debt that sounded good, but it's not actually great. Some ILFS, something, and all of this. Now, the issue with this is when they start getting redemptions. Let's say there's a crisis of some sort, people are redeeming money from that debt fund. What is he going to be able to sell? The answer is not the debt that is, in question. Because an ILFS debt nobody wants to buy. But people are very happy to buy, say, a Reliance or a government of India securities or a state development loan. So you're going to see them start selling consistently the top, the most, the goodest or best of the debt that you have of all of the debt that you own. So when you started off with 70% good and 30% bad, because of redemptions, it may become 50% good and 50% bad. And then 40% good and 60% bad. You're getting an increasing share of if you're an existing investor, you're getting an increasing share of the bad debt, if you may. And so that may not have been what you wanted when you started. So you might have said, listen, I bought this because it was mostly AAA debt. And now you're telling me it's mostly AA and, A level debt. I don't like this. So in that sense, you do have a problem. And sometimes what this happens is these things are fairly well known. We've seen this. There was a fund in 2016, 2015 or 16 or something like that, owned by, at that time it was JP Morgan. JP Morgan Mutual Fund had this fund. They had invested in this debt of this company called Amtech Auto. Now, Amtech Auto was going to default. Almost everybody in the industry knew that this default was coming. So what was happening really was, how do you get your money out? Because before the default hits, because the day the default hits, that debt is going to be marked down to zero. So today it's marked at 100 rupees to the rupee. So if it's a 100 rupee bond, it's marked at 100 rupees today. But the day it defaults, it'll be marked at like 10 rupees or 20 rupees or maybe even 0 rupees. So essentially, you want this bond default to not affect you, but you know that as a owner of this mutual fund, its NAV is 15 rupees today. If this bond defaults, it's going to come back to 14 rupees tomorrow. So the debt fund is going to see a big loss. So what some people did was they got out before this default hit, because they knew when the default was going to come. The due date was a certain date. They got out the day before. Now, even the mutual fund itself would have had to sell something in order to redeem all of this stuff. So they would have sold some good debt. But unfortunately, what happened, or unfortunately for some other people, there's a big Bangalore-based startup that raised a lot of money on roughly exactly the same day. That money got into their bank account and their bankers told them, very conveniently, that they should be buying this JP Morgan debt fund. So they put 100 crores into this JP Morgan debt fund. That 100 crores was used entirely to help the exiting investors redeem their money without having to sell the underlying portfolio. If you were an existing investor who didn't manage to get out, like a certain large motorcycle group did not, and they were very unhappy about it, that day you were investing in a fund, or you had stayed invested in a fund where some other investor managed to get out through a new inflow that came in, but tomorrow your fund fell like 5 or 7% in value, and you couldn't do anything. It was the Bangalore startup that got that 10% or 15%, whatever that number was in terms of the drop. The exiting investor who knew was able to exit in time, and this outflow created this mechanism where you imagine the Bangalore startup. It's like, dude, I didn't do anything. I got in and I got 5% down the next day. That means instead of raising 100 crores, I raised 95. I mean, I've just lost 5 crores on day one, right? So you just transferred the losses to somebody else. This would not happen in a non-pooled vehicle, because if it was pooled, that's why you have this loss in the first place. So the outflow and inflow dynamics, has issues.
On this, quite terrible for the startup to invest their money this way. But they shouldn't have been investing in this debt mutual fund in the first place, right? I mean, this isn't just a pool vehicle problem. This was clearly just a bad debt fund to invest in. Would you agree?
To be fair, if you didn't know about the Amtech Auto debt, you would have thought it's perfectly fine. In Franklin's case, which was a different situation that happened in 2020, everybody knew their debt was a problem. So their problem was that their fund the flagship fund was about 20,000 crores. And we did a podcast about it at that time, I think. And that 20,000 crores went down to 12,000 crores. There was 8,000 crores worth of redemptions in 6 months. They literally sold all their good debt they could. By the end of it, what was left was a bunch of debt that simply could not be sold. In fact, the AMC itself borrowed money from the market, more than 1,000 crores, in order to repay exiting investors, saying that, listen, whenever we are able to sell this, we'll actually sell this and we'll pay the interest on that borrowing eventually. But they couldn't sustain more than that and they lost it. So I think to a certain extent, that was a problem of liquidity. So when they had to halt withdrawals, SBI was told to administer the fund. SBI then took all the funds, sold it over the next 3 years. They generated the return they could. But literally saying that the investor who got out earlier was lucky because it's a pooled vehicle, and the investor that got in later, I think that was the complexities.
I'd add one more in this Bangalore startup example. I think the thing that's particularly irritating or galling, if you're the startup or if you're someone observing this neutrally, is that your money didn't go to improve the quality of the debt fund at all, even though you may have added, say, a meaningful number like 100 crores or whatever to the debt fund, which could have improved its overall profile. But your money was basically, it showed up in a bank account and was almost instantly used to redeem someone else. So you had no impact on the fund. It was like you bought it off someone else in that sense.
Yeah, I mean that is the problem with unfortunately you have no awareness of this. You have no awareness. For instance, in the morning I could buy a fund. By the afternoon, a redemption could happen. This could be completely unknown to you, and you have no idea that your purchases have been used to redeem someone else's exit versus going to the fund actually.
Now that you bring that up, this is a topic that came up last week when we were meeting some people from the industry on both sides of it, that there is sometimes an issue of it's not just whether you've added money at the wrong time or if you've added money and other people have added it later, but there is a cutoff timing problem as well. And so when you add money matters and what NAV you get matters. And sometimes this is a cause of much grief with people who've added money thinking they'll get a certain NAV and then don't, either because of someone's mistakes along the way or someone not doing their job properly that day for whatever reasons, or just a wrong misunderstanding at the level of the person who's adding money. And as you know, sometimes I think this came into very stark relief on a 3-day period around the Indian elections, general elections in May or June 2024, when one day on exit polls the market went up a lot. The very next day with the actual counting, the market fell a lot. And then the third day, I think the market kind of rebounded for whatever reasons. So it seems no one seemed to get what they wanted and everyone actually got pretty much the opposite of what they thought they would get. So could you expand on this?
Yeah, so the timing issue is actually quite complex. Now, SEBI says if you invest your money into a mutual fund before 3 p.m., you should get the same day's NAV. The same day's NAV means all the stocks that were on the portfolio on that day marked to market at the closing price of the day is the closing NAV of the day. Now, if you invest a lot of money, you're expecting to get today's NAV. Except your money is likely not even invested by the fund at that NAV, because what happens is the fund simply says, listen, you may have put in 100 crores, but I may get redemptions of 75 crores. So the fund holds off on that money and perhaps buys it the next day. So for instance, also if you have up till 3 o'clock, the markets are only open up till 3:30. So you may invest money at 2:59 p.m. The fund manager does not have the time to be able to get this money, get the information that this money has come in and make all the purchases before 3:30 in the evening. So what's he going to do? He's going to buy the next day. But he's already given you the NAV of today. So if by the next day morning, he's gone in and bought a ton of stocks at a much higher price, what has he done? He's given you an NAV of 100, but he's bought when the NAV was probably 104 or 105. It hurts the existing investors of the fund. That means that existing investors before you came in were like, oh, this fund should grow, roughly at this thing. So to give you a rough example, let's take an extreme. The extreme is that the market has gone up 10%. I'll give you two examples of how complex it is. One is if you invest at 9 a.m. saying, I know the market's going to go up and I want to invest. I put my money in at 9 a.m. I'm going to get the end of the day NAV. The market goes up 10%. I might have invested before it went up, but I only get the end of the day NAV. So now I'm feeling like, oh shit, I got it right. I was trying to time this and it didn't work out.
And if you had been doing the exact shares in your Demat account, you probably would have you called it correctly maybe, right?
You called it correctly, yeah.
And so you would have seen the appreciation in your Demat account had you been going around buying the shares because at 9 a.m. you would have placed your trade. Perhaps. And then over the course of the day, the 10% rise would have happened. And so you end the day 10% higher, hopefully.
Yeah, it's like literally the same stocks that the mutual fund owns. I could have owned those stocks and I would have made the whole return by the end of the day. The other one is if you invest your money at 2:59 p.m. Now you've invested your money, the fund manager has seen the stock market going up, but by the time he gets the money, he's like, listen, I'll do this tomorrow morning. So you put in 100 crores into a fund whose NAV also is 100 crores. Now you can't do this technically,
so
but
AUM is 100 crores.
AUM is 100 crores, sorry. AUM is 100 crores, you added another 100 crores to it. Next morning, the market goes up 10% on open. So your 100 crores would have become 110, right? Except you put in another 100. So it's 200 crores becoming 210 because 100 was in cash. He's not yet bought anything. Now the way it works is, if it was 100 going to 110, my NAV would have gone up 10%. But if it's 200 going to 210, it's going up only 5%. So both you and me, that is, as an existing investor, I see my NAV go up only 5%. You also see your NAV go up 5%. And by the time the manager buys, your NAV is already up So essentially, you've diluted my upside return by adding more money or a large sum of money into the funds. And I don't even know this. So the next day when I look at my NAV, I'm like, wait. Didn't the market go up 10%? Why is my fund up only 5%? And I complain. You, on the other hand, you have no idea because you're a new investor. You're like, yeah, of course, it went up 5%. But this fund is bad. This fund is not good enough because it didn't, but you know what? There was no choice. It's a pooled vehicle. It has to give you an NAV at some point. That cutoff timing has created a problem. You could solve this in complicated ways by saying, no, his actual purchase price is only what's going to impact it. But that's way more complicated. It doesn't work for the common universe. So you have to have a cutoff time for an NAV. I think this has a complexity then on the other side as well. So which means you add the same two things on selling. So if I sold in the morning saying, listen, the budget is a bad budget, I need to sell now. So you sell a mutual fund, but then you only get the price at the end of the day. So you might have made the decision to sell at 10 in the morning, but the market has fallen another 10%. Now you're feeling like, oh, you know what, I had it right, but guess what? I got the 10% lower NAV in the first place. The second one is the same thing at 259. If you sell, the next day the market goes down 10%. And while it's down 10%, your fund manager is now trying to sell. Except he has to honor the NAV he gave you. And that then becomes a problem because you will get your 100 rupees. But what happens to the rest of the money is that it has, okay, let me give you the rough statistics here. Let's say there's 100 crores and you withdrawn, maybe 20 crores. Technically, I should say 100 crores NAV, 20 crores less, we should have 80. And if the market falls 10%, 80 should become 72. Simple stuff. That sounds okay. But what actually happens is the 100 crores that is there first falls 10%. So it goes to 90. Then I need to give you 20. So I sell enough stocks to give you 20. So I give you 20 from the 90. It goes down to 70, not 72. Instead, so there's a 2 crore extra loss that I have faced as an existing investor in the fund simply because you redeemed at yesterday's NAV when the prices were higher than where they are when they are sold. So in that sense, I hurt because I'm an existing investor out of actions that you've taken. I don't even know who you are. You're irrelevant to you were supposed to be irrelevant because we're supposed to be an anonymous pool, but your actions affect me as well. So that's...
Okay. But, the reaction that's coming, I'm kind of thinking as the aggrieved investor who to be upset with in this. And I would think my primary grouse would be with the fund manager. Like, dude, you just need to have more efficient operations here. If people give you money by 259, make sure you damn well buy this stuff by 330 because one way or another. And that should be possible today, right? Everything is digital in the end. Reconciliations are fairly straightforward. If the money doesn't show up in time, perhaps you're not obliged to make it part of you're not required to honor the NAV of a particular day and so on, and then it becomes the new person's problem, not the existing people's problem. So I feel that my primary fury should be directed towards the fund managers here saying, get your act together. So that's my first thing. And the second question is, don't ETFs in theory solve this? Because they're supposed to move in tandem with the stock or with the underlying value over the course of the day. There are so-called market makers out here who make this their prices match the ongoing price. So if you're someone who really cares about this intraday sensitivity or whatever, aren't ETFs your best friend then?
This is a great two questions. Now, the first one is about should fund managers not be more efficient? I think the answer is yes. So, for instance, if I get money at 9 in the morning, I should be buying stocks. And if I get redemptions at 3 in the afternoon, I should be selling stocks. So I should buy and sell. Yes, there's a transaction cost to the whole thing, but I think in general, you will not get large entries and exits at the same time. You'll either get large entries or you'll get large exits because that's how the markets work. When things are good, everybody wants to buy. When things are bad, people want to sell and so on. So because you can model this behavior down, you can say, well, if I'm getting redemptions, I better sell. And I better sell today itself before the NAV is released so that I don't have to deal with this issue of the next day. The 9 o'clock purchase problem, getting the end of day NAV, that's by default the structure of mutual funds itself. So you can't change that. So since everybody is aware of this, I think it should be made possible for everybody to understand. We could solve this by the ETF by saying, oh, you know what? If I buy right now, the market's going up, and if I instead of buying a mutual fund, let me go buy an ETF because the ETF has a price in the market, and I could buy it and I could benefit from the intraday move of 10%. The same day that you had an example, which is, I think, July 4th of last year, the market was down 6%. People in the ETF world were seeing drops of only 2%.
I guess they were lucky.
The ETF holders were, but the people who wanted to buy were like, listen, I need to buy it 6% down, not 2% down. So how do you do that? What happened at that time was there were a bunch of ETFs that were available, and some of them were down 5 or 6%. Some of them were down only 1 or 2%. That's because to bridge the arbitrage, you need the market maker to come in and buy and sell directly from the fund house and then place orders directly on the exchange in order to bridge it out. The problem with the market maker was he had only limited capital, and then he chose a few ETFs to kind of market, but the rest of it was out there and the arbitrage never bridged. So even on a deep down day, because of ETF complexities, which we'll cover in a different podcast, I think that betting on an ETF to not fall as much or to having to fall so much that you could buy it at a much cheaper price, both of these are invalid assumptions, if you may. So if I want to buy it or if I want to sell something, I should be able to sell it at close to its NAV price. But it's not always true in an ETF in an extreme situation.
No, I just realized this. I mean, I guess this problem may not happen abroad for different reasons on the US stock market. But I know at least in the last 2 months, I think at least twice we've had a situation where over the weekend, bad news has been processed in the US. Once when that DeepSeek announcement happened, and I can't remember the other reason, when everyone thought that all stocks are now going to correct massively. And they did open on a Monday very dramatically lower. But had these markets been facing the same problem, you're like, oh, I know this is an overreaction, I want to get in. But if the ETF you're accessing has only fallen 2%, whereas it should have fallen 5%, then you're not getting the ability to play this or to take advantage of your knowledge on this trade.
Exactly. And in fact, you don't even know. So for the most part, you're looking at the ETF and saying, the only reason you know is everything else is down 6 and this is only down 2. And you're wondering why. And then this is the answer for why.
Fair. I mean, if it was a straightforward ETF where you could say, oh, this is an S&P 500 or QQQ ETF, I guess you could look at the benchmark and compare. But oftentimes the ETFs are a little more active and their weights may not be the same. And you don't realize that you're actually not getting what you think you're getting because of some strange behavior on them.
In fact, the correct way to do things would have been to buy a Nifty future, which was already down quite that much at the time. Use the Nifty future until the price had balanced out. That means this glitch had balanced out, and then transfer that money into the ETF. So if you want to buy 5 lakhs worth, you would buy 5 lakhs worth of the ETF. By the way, now you can no longer do 5 lakhs. It has to be, I think, 10 or 15 lakhs or something like that. But if you had that much money, that's what you would have to do. But guess what? This takes a PhD to understand that, listen, I just want to buy the market when it's down. I will buy the future. I will wait for the prices to converge so that the ETF and the underlying NAV are the same price. And then I will shift from the future to the ETF. This sounds like a little bit of like, come on, I'm driving a car, not a rocket ship kind of thing.
The people I know, I know we know different people, but the people I know who use futures aren't looking to make 2% intraday. They dream of bigger numbers, and this wouldn't make the cut for them, even though they've never made them. But anyway, the point.
That's a good point.
All right, so this point is well understood. I'd like to get into the topic of. You alluded to this in, I guess, sort of in the Franklin example, a bit in the Amtech example, but then we stopped over there, which is what happens when the pool vehicle happens to have a terrible asset or an asset where just some weird stuff is going on and its price is temporarily not representative of what's supposed to happen for various reasons. I know there can be 100 different edge cases here, but I think you have a couple of interesting examples to give where you have a fund or a pool vehicle in front of you, but the price you see is not really the price that's accurately representing for various reasons. Could you get into this?
Yes, I think we've seen these 3 examples in the last 4 or 5 years. One is, I'll give you one equity example and 2 debt examples. One equity example would be Yes Bank, and the 2 debt examples would be DHFL and Z promoter bonds, called as SL bonds, if you may. But let me talk about Yes Bank first. Yes Bank went through a kind of a reconstruction of sorts where new capital was brought in by SBI. So the regulator said, listen, whatever is your current current period. This is 2020 March. They said, well, you know what? Whatever shares of Yes Bank exist today, 75% of them will be locked in for the next 3 years. That means they can't be sold. So a mutual fund that owned a Yes Bank share, and remember Yes Bank was part of the Nifty as well. So a lot of mutual funds owned it. The shares cannot be sold for the next 3 years. Now, as a fund manager, you're thinking, listen, if I can't sell it for the next 3 years, it doesn't matter that the rest of the shares, the new shares that are in the market are trading at 9 rupees per share. I can't sell these shares. So technically, I should mark them at zero until they can be sold. So you created a problem where now you have shares in a portfolio. They're marked at zero, but there is a market price to them. There is an actual value to them that you can exit them for, but for 3 years, they can't be valued. So what happens then is that why do they do this valuation at zero is a simple rule that because if you don't value it at zero, if you value it at 7 rupees, then you can keep getting redemptions. When you keep getting redemptions, you can sell everything except the Yes Bank. Eventually, your portfolio is like 50% Yes Bank. And the NAV is not reflective of the underlying value at all because the underlying value of Yes Bank is not 7 rupees per share. It is 0 rupees per share because you can't sell it. So what they do is they say, well, forget this liquidity. Let me just put zero as the price and leave zero in there. Now this creates an opportunity on the other side. 2 days before the lock-in, you have an artificially depressed NAV. You're completely aware of this, but there's 2 days to the lock-in. The share is trading at 11 rupees per share. This share is 10% of the NAV because the mutual fund has not done very well or scheme has not done very well. There's 10% of the NAV sitting at the 11 rupee price, but except the 10% of the NAV is zero right now, and you would not be able to sell it. But 2 days later, the price will jump by 10% simply because the share can be sold and therefore it will be valued at 11 rupees per share or whatever the value is. Now, it means that if you are aware of this, you could actually walk in there and say, you know what, my mutual fund value is going to jump up 10%. I go and put in money. Lots of people like you come in and they put in money. Guess what happens? It's because when you are an equity investor and let's say the fund was only 30 crores in size, 3 crores of it was Yes Bank, but 3 crores is marked at zero. So the NAV should jump to 33 crores. Except a lot of people like me have gone ahead and seen this and we come in and pump in, another 30 crores. So instead of the value going from 30 to 33, the value jumps from 60 to 63. Because they couldn't buy more Yes Bank anyways. So instead of seeing a 10% jump, I, as an existing investor that held all through these years, I'm seeing only a 5% jump. But when it fell, I saw a 10% drop. So essentially, you've created a pooled vehicle with a problem of an lack of value of things, and things move on. Interestingly, the SEBI saw this problem in first the SLZ bonds, where they saw this and in the ILFS bonds actually earlier. But the idea here was the simple: if you mark them at zero and people knew it existed, they could wait till this bond became sellable at some point, and then they could kind of time and game it. Now what happened in this case and in a particular set of cases was that there were two things that started to happen. In the Z bonds, companies were told to move, mutual funds were told to move their Z assets into a separate holding thing called a side pocket. It's called a side pocket. It's called a segregated fund, but it's a side pocket. Essentially, you take it out of the existing fund and give units of this side pocket only to those people who were invested on the day it was moved into the side pocket, not to people after that. So essentially, when the side pocket actually earns money, only those people who were holding it on that day will see a jump. So I do see a 10% drop. That 10% goes and sits in a side pocket, and eventually, if the side pocket earns money, that comes back. Now this side pocketing concept happened, I think, in 2018, 19, 20, something like that. But in 2020, because the side pocketing had come in, there was a very specific rule that said, well, you can't move it into a side pocket unless there is a downgrade in rating. Why? Because SEBI was like, I'm suspicious of you people who call yourselves mutual funds. You might actually decide to say anything that is illiquid that you don't like will go into a side pocket. So I won't allow you to move anything to a side pocket unless an event happens. That event is a rating downgrade. Vodafone comes in and gets this massive Supreme Court order. the Supreme Court order says, look, you guys have to pay these AGR dues, which technically renders Vodafone instantly bankrupt. When your company is instantly bankrupt, your bonds will get downgraded to default rating or close to default rating. When you do that, a person who owns this mutual fund will have to move it into a side pocket and mark it at zero. That's the standard thing. Except the rating agencies were not looking at this decision immediately and downgrading it. They had a 1 week time period before they would downgrade it. And everybody knew this. Guess what? Even we at Capital Mind knew this. We actually wrote about this and said, you know what? There's a certain Franklin fund that contained this bond. Franklin said, listen, if we wait for the downgrade to mark it to zero, all you buggers will come and sell this ultra short-term fund and try to get the valuation of this Vodafone bond at 100 rupees when I know it's going to go to zero because it's going to be marked default eventually. So they took a call and said, listen, we're going to mark it at zero right now.
Sounds reasonable to me.
And except people like Capital Mind are looking and saying, oh, wait, you're going to mark it at zero and then move it to a side pocket eventually. So if I bought your fund today and sold it the day after you moved it to a side pocket, I would get the side pocket for free. So now my bet is, does Vodafone pay back anything, something, nothing, what? So I get this whole Vodafone side pocket for free. So we said, let's buy it now and a week later, let's sell it. There will be no drop in NAV because you already marked down the Vodafone bonds to zero. So it contains nothing in your NAV. So we bought it, we sold it. We sold it for 0.5% or 0.1% or something differential in value. And then 6 months later, when the Vodafone bond was going to expire, they paid back the full amount. So technically, whatever drop there was in the value of those Vodafone bonds, I got all of it. Now, I'm not saying that this was a good opportunity, except again, it needs a little bit of a PhD to understand what's happening behind the scenes and so on. But it does create this problem because some existing investor somehow has, and new investor, there is a complexity in it that has created, if I have created value out of this, then obviously some existing investor has seen a loss of value. That's simply come because we walked in just about at the same time that everyone else is. There is another complexity in I think the DHFL bonds. Now this was the last bit that I wanted to mention where the complexity was because it was a regulatory, the complexity was because there was a regulatory arbitrage. The regulatory arbitrage was simple. DHFL had defaulted. By definition, it had to be marked at zero. For a long time, while the DHFL bankruptcy was going on, bonds were trading because DHFL's offers for bankruptcy resolution, all of them contained one thing, that we will pay back 20%. So a 1,000 rupee bond was trading at 200 rupees in the market. But because mutual funds were told that this is a defaulted bond, they were told to mark it at zero. You could sell them if you wanted, but SEBI specifically said a defaulted bond cannot be sold for a mutual fund. Now somebody went back to SEBI and said, why have you said this? And SEBI said, well, who buys defaulted bond, man? Come on, we never thought of that. So they're like, no, it's not defaulted. It's defaulted, but there's a resolution plan. And this is the first time something like this has happened, right? So now SEBI is thinking, well, okay, yeah, fine. We had a regulation where we thought nobody will want to buy a defaulted bond. That's why you have to market at zero. But now in this strange situation where people do want to buy defaulted bonds, we should allow our mutual funds to sell. So they said, well, you know what, we'll discuss this. Apparently, all the mutual funds were the ones who were gunning for this and saying, listen, we have this DHFL bond. Let's sell them. Let's get rid of them and all that. There was a particular mutual fund, and I won't name them, but whose management was obviously aware of what was happening. The CEO of this particular mutual fund realized that SEBI is going to now allow the selling of this mutual fund. Now, the structure of this particular mutual fund was, there was about, I think, 30 odd or 40, there was a certain amount, maybe 100 or something crores of AUM, because the AUM had fallen since then. But when this rule would open up, roughly 20% or so would be added to the NAV, simply because this 20% represented the value of the DHFL bonds if it was valued at 20% of, so essentially at 200 rupees to 1,000 rupees, 20 paisa to a rupee of face value, you would actually get a massive 20% jump in the NAV. The CEO of this mutual fund knew this and purchased some 20 crores of this mutual fund in his own name. roughly 1 month before the rule changed. Eventually, he saw the NAV go up, but not by 20, but it went up about 14 or 15% because his additions diluted the value of the growth that the people would have seen, and effectively benefited. Of course, SEBI caught it because they were more worried about this being insider trading, saying you knew something was happening with the public didn't know. And if you knew that something, for instance, what I did in Vodafone, in say a Capital Mind, what Capital Mind did in a Vodafone at that time was not illegal because we used information that was public. We did not use any information that was not public. So anything that is not public information can be used in arbitrage to as much as you want. But if you change this value to saying that I'm using non-public information, then it's insider prevention of insider trading applies, and therefore boom, 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 and they got flagged. And because of this weird situation where this one time in a million times event has happened, all mutual fund employees are required now to declare that they don't have any insider information that is non-public that is going to affect the NAV of the fund before they can buy units of their own mutual fund. So I could buy, if I'm an employee of Nippon Mutual Fund, I can buy an HDFC Mutual Fund, but I can't buy anything that's a Nippon Mutual Fund because of this certain mutual fund CEO who did this certain transaction at a certain point. So a lot of rules are, of course, this thing. But I mean, eventually they'll come down to, oh, well, you can do up to 5 lakhs or you can do up to 10 lakhs. So I think slowly they'll dilute that rule. But you can see how, what I'm trying to mention here is some of these pooled vehicle problems are very peculiar to the pooled vehicle and information arbitrage within the pooled vehicle itself.
I just wanted to not quibble, but ask a variant of that Yes Bank situation where, let's say it had been separate managed accounts and then we found out that Yes Bank shares were going to be like locked in for 3 years or whatever you said they would be. Isn't that the same problem in this Yes Bank thing, whether it was a separate managed account or a pooled vehicle or not really?
Yeah, no, it's true. It's absolutely true because what would happen then is they would lie in those separate accounts. In fact, if this concept of the side pocket was allowed in equity funds, it was not. If it was allowed in equity funds, then you could have side pocketed the Yes Bank exposure and kept it into a separate fund, and that would have been perfectly fine. Except SEBI chose not to allow it to side pocket at the same time. I think regulatorily we should have been faster and allowed the side pocketing of a Yes Bank because it's a one time in a million time event. How many times do you get a large bank like Yes Bank, which was part of the Nifty, to be to have a value in the market, but force all existing shareholders to be locked in for 3 years? So I bought it when there was no lock-in. I bought it and held it through this time. The share exists, the company exists, there is a share price. I could buy new shares and sell new shares, but I can't sell my existing shares. This sounds like such a wild thing. They should have allowed the side pocket to happen in the first place. But a side pocket would have had exactly or roughly exactly the same issues as individual pools. But you're right, the individual pools will be easier to manage because if it was an individual account and I was a manager of that individual account, I would have to tell my customers, listen, you have an NAV of say 1 crore, but 5 lakhs out of this 1 crore is in Yes Bank shares, which have a value of 5 lakhs, but you can't exit it for 3 years. I would literally have this disclosure with every single NAV declaration. And of course, this would make a lot of sense because then you have valuations like this. But I feel in the end, over the long term, the problematic area over here comes from the vehicle being a pooled vehicle rather than being individual accounts, because individual accounts are much easier to manage in extreme situations like this.
Also, if as I said in the example where other people come in later to take advantage of the eventual recognition of value of it, I'm not hurt by other people coming in an individual account.
Exactly. This concept of some bonds. I mean, you've had this problem, right? So I think.
Yeah. In fact, just to share, so I had invested in a global fund, and I think about 5% of that fund was in Russian stocks. Initially, they collapsed, and then they got frozen. And so even now, I've redeemed from that fund. There is still some tiny stub position. I mean, I guess right now it's 1 to 2% because it I guess still trades in
Plummeted.
Russia, and so they're trying to market even though you can't use it, of a side pocket in this fund, which I still have of exposure to Russian stocks in this weird situation. But there the side pocket was allowed, so it's just illiquid rather than being a loss. Although I imagine that I shouldn't be in a tearing hurry to sell them the moment if and when they open up.
Because everybody's going to be in that tearing hurry, and it's like eventually, if you think Russian stocks will do well, which I suppose because the lock-in is opening up, they might be.
They might become the 51st state of the US the way things are going. You never know,
So
right? Along with
52nd
Canada or
wave,
something.
yeah.
Sure. Okay, but I'll come back to my thing. So you've managed to destabilize my view on pool vehicles and mutual funds in particular to some extent on this, because all these extremely thoughtful and well-meaning regulations that SEBI has to put in to prevent people from taking advantage of it. And we've seen a history. Every time someone messes up in some way or takes advantage of a gray in the rules, SEBI has to come in and essentially say, okay, you can't do this, and this is how we're changing the rules to react to the last bad behavior written by any mutual fund participant. But I feel sufficiently rattled by all these different edge cases. Like it seems like if the market is falling and I want to take advantage of it, it's too late in a mutual fund, basically. You probably can't take advantage of it unless you're like super nimble, because by the time your money gets deployed, it's going to be post some cutoff, or you're not going to get the NAV you want. So that's one timing thing. So, but fine, you can say if you're in a mutual fund, you shouldn't be timing the market on an intraday or a one-day thing. You should have a slightly longer time horizon. Point is accepted. But even then, the fact of the matter is that if the markets are going to give you 15 to 18% every year or on average for the next 5 years, then nothing matters. But if there are going to be these catastrophic events or these edge cases, then you do want to be able to be nimble around them and move in and out, but or take advantage of them. But here it seems in a mutual fund, you're constrained. I mean, you can do everything right and just not enjoy the upside that you should, because other people with more capital who do this for a living are able to just swoop in and dilute some of the gains that should have come to you. How do you come to peace with that? Does this mean that people should not be as like blindly trusting in mutual funds, or just say everything is for the super long term and I won't care, or ignore these things saying, look, these happen once a year, don't worry about it? How would you reconcile these problems of pool vehicles with the faith I had in mutual funds coming into this chat?
No, I completely see you, and you know what? I'm sitting here making these extreme edge case arguments. Like it's like the guy who vital statistics who says the world is going to fall on his head. All sorts of stuff maybe. But let me give you the parallel of what I'm actually trying to do. In an aeroplane, when you go, there's an air hostess that will come and tell you how to wear your seatbelt. But she will also tell you about here is the exit row. And if you're sitting in an exit row, you're going to get special instructions on how to open that door by pulling this flap and removing that. And then, entering your birth date in a register, whatever it is. So, and then they tell you how to wear a life jacket and to blow into the thing. And there's a balloon and there's some kind of whistle and light. And so all sorts of things are being told to you. This is because of that extreme crazy edge case where once in 100 years a plane will land on water. The only rescuer possible will be the guy sitting in the exit row who will remember all the instructions given to them at exactly the right way, who unfumblingly will be able to open that door, inflate that slide, all the passengers will be able to go out and wear their life jackets because they're in the water now somewhere and survive. So, the fact is this is so rare because, we fly hundreds and thousands of flights every day. And relatively speaking, this is probably less likely than you getting hit before you walk onto the road. Technically, if they did the same thing for people walking on the road, there would be a person saying, when you walk on the road, please look to your left, please look to your right, and so on. But nobody does that. But they do it in an aeroplane. And the aeroplane industry is fine with it. We are also fine with it. It's like, we repeated it so time. Maybe I am that air hostess in that sense, saying this is in this extreme case. There is these things that can happen, but don't worry, these are not life-threatening. Unlike in the air hostess case, it may be more life-threatening. It is just the nature of pooled vehicles to behave that way. There are those problems, but it's okay. We can live with them because if you didn't get in at 6% down, maybe you'll get in at 5% down. But that isn't the end of the world. It's just the way the pooled vehicle behaves in certain cases. And your fund characteristics are changing based on other people's actions all the time. So it is no longer important for you to just select a mutual fund and stick with it. It's also important to understand whether that fund changes. It's a flexi cap fund, you don't care because that's what a flexi cap fund does. But if you bought the flexi cap fund because it had foreign exposure, chances are it doesn't now, and that's not the reason why you want to hold it anymore. If you're okay with that, then you're okay with holding the fund. But if you did want foreign exposure, then you need to buy some other fund or take your money outside using an LRS route and then buy your foreign exposure elsewhere. It's just that things change and you should be aware of these changes. And these changes are happening because it's a pooled vehicle, not because it's a separately managed account for you. And that's what makes you behave in a better way. Because once you're aware, you can fix it. It's just that you shouldn't be told these things at a later point and said, oh, well, this seems to be an extreme surprise.
And I guess if you start thinking about stocks, there'll be a lot of edge cases when it comes to just direct stocks as well.
Absolutely. I mean, when stocks merge or demerge, there's a stock that's not listed for 3 months. What do you do with them? What does a mutual fund do with them? For instance, they do have stocks which are demerged from your current stocks that they own that they can't sell. They don't mark them at zero. They mark them at some value. But that's almost like a calculated risk that the whole industry is taking that, boss, this stock will list someday. Chennai Super Kings was delisted from India Cements or demerged from India Cements. It has still not listed. Possibly those shares exist in the hands of mutual funds that owned India Cements on that day, except they probably marked it at zero by now because they're like, dude, this guy is never going to list, and you know what, Dhoni's won enough matches, so or something like that, So, but at some level, you have this complexity that tomorrow there will be this random news that Chennai Super Kings is listing, and certain mutual funds will come on Twitter and say they own Chennai Super Kings, and therefore their valuation will go up, and we should buy those mutual funds. And so this is not abnormal. This is just the way the industry is, structured to be. And I may be pointing out something that will never happen, but when it does happen, I hope we remember this podcast and say, well, what, we saw it then.
And anything actionable here for investors other than don't try to time your mutual funds too finely, and any funds to avoid, maybe ones that are too small, or any action and insight on when to get out of a fund. Like you bought this amazing small cap fund, it's now 10x in AUM. There doesn't seem to be that much small cap AUM going around. Any guidance that you could give people who find themselves in these positions?
Yeah, I think it's interesting because once you identify them, what's the action, right? So for instance, one of the reasons why we were able to exit, say, a Franklin Ultra short-term fund, or tell people to watch out for it early, was that we were able to look at their AUMs falling on a month-on-month basis from November to March. And in April, we said, listen, there's something wrong. These guys have lost nearly 40 or 50% of their AUM. Even though they're a very large fund, we need to be careful about looking at this at that time. And we avoided an issue that happened at the time, but interestingly, that had a kind of a happy ending in the sense people were able to recover all their money and some more. But the larger consequence of all of this is that you need to look at your funds. Watch out for a sudden drop or a sudden increase in AUM. A sudden drop may mean that if you're currently invested, you may be seeing that your exposure has resulted in the fund getting more risky. And if its AUM is increasing dramatically, you may be seeing that the fund manager's strategies have changed because of the size of the fund. And therefore, your initial thesis of why you like this fund may no longer be applicable. But I think this is now even an annual exercise, a once in 6 month exercise is enough. You don't need to look at it on a daily basis. The bigger thing that I would say to you is what you said. Don't try to time things using mutual funds. They don't necessarily work. Also, don't believe that any of these things are abnormal or a problem of the mutual fund industry, because we haven't got to a level where things are so efficient that you can do it at this thing. I hope we can change that in the future, but I think we should realize there are limitations in the settlement process, information transfer process, so that these inefficiencies will remain for a while.
Thanks, Deepak.
Yes, thank you so much.
Well, thanks for listening. If you'd like to hear more episodes, then do visit capitalmind.in/podcast. And if you'd like to learn more about our investment products, then just visit capitalmind.in to find out about our portfolio management service, where we invest in stocks and mutual funds if you have more than 50 lakhs that you can allocate to us. Till next time.